So, obviously, we are going to be watching the carnage that is non-farm payroll here in about 20 minutes or so. And I want to remind you that I never know where it's going to go. Non-farm payroll is a carnival ride, and it can be very damaging if you go out here and try to speculate ahead of it. Treat it like a FOMC. You don't know where it's going. Treat it like CPI. You don't know where it's going. Like a PPI number, you have no idea where it's going. So it's always better to simply wait. Wait for it to do whatever it's going to do. Wait about 15 minutes and then see what the lay of the land looks like after that. Meaning, what inefficiencies are still in play? What smooth areas above or below the marketplace? 15 minutes minimum after non-farm payroll hits. So that means 8:45 Eastern Standard Time, New York local time. That's when you have the green light to start going in and seeking opportunities to study. If you're brand new, if you're a brand new student, you're a brand new trader in the making, if you will, if you have studied with anyone else, if you're coming to me, I'm calling you a brand new. Okay, because chances are you probably learned a lot of stuff that has absolutely no bearing on why price is going to move. So it's no question as to why you're losing money if you're trading on these days, because you're trying to do something that is ill-equipped to handle the uncertainty that even my concepts will not deliver the clarity that's required to be positioned ahead of it. So that's the reason why I tell my students, if you're brand new, don't trade after Wednesday morning, New York local time, on non-farm payroll weeks. And you can see Wednesday was a little bit of a challenging day. Thursday was a little bit of a challenging day. If you're new, if you don't know what you're doing, they can be very problematic. And then you're met with, obviously, the king of volatility for this particular week. It's the non-farm payroll. It's usually the first Friday of every month, 8:30 a.m. And leading up to that number, it can be a little unruly in price, meaning that it can start to consolidate and then create these little sharp little jabs above or below and go right back into consolidation again. And you can see pretty much that's what we've seen here. Now, there has been, for completeness sake, in my career and since I was doing mentorship with the Forex pairs, there has been non-farm payroll weeks where during the Wednesday and Thursday, very favorable price action was available, put it that way. But that's usually far and few between, so it's not the standard. I always try to study non-farm payroll, and then we look for the opposing side to get traded to. So in your mind, that's all I want you to do today, and every non-farm payroll going forward. And I'm going to tell you why this will fail as a studying mechanism as well. But initially, I want you to look at the chart, start with a 15-minute time frame. It's very, very simple rules, okay? What you're going to do is about 8:15, quarter after 8, where you have 15 minutes or so. We have plenty of time, so I can still jawbone and cover what I'm going to say. But 8:15, you want to see where market price is at that time. So we give ourselves 15 minutes before the actual news release at 8:30. So now let's go through the liquidity pools. So we're essentially right here at 8:15. So we look back, we cleared this high, so that's not a liquidity pool. That high right there, it's a wick, but still high. So we drop our level right there. And this is a close proximity buy side liquidity pool, meaning this is going to be your minor. So you have to look for something above that one. Real simple. Top left, and we'll go to minor. All right, you ready? Was that hard? It complicates everything. All right, so going back from this area here at 8:15 or so, go to your nearest low. That's not a low, I would consider that. This right here, this is a minor sell side liquidity pool. So you can do this. All you're doing is looking for the closest one at a specific time right before a news event. All right, so they have minor sell side liquidity and minor buy side. Now you have to take a little bit broader look above that. Okay, so we have this. Now look at what we have here. We have all this consolidation and all these little lows down here. On a news report day like non-farm payroll, they're going to go way outside what you think is reasonable. That's the problem with non-farm payroll. It's so uncertain, and they can go way out of spec in terms of average daily range. They can go outside of what you think it could go to. So I would not look at these consolidation lows as anything of importance. This is the minor sell side liquidity pool, but cut through all this consolidation, go right to these relative equal lows. So this right here is going to be primary sell side. Primary is just the next logical level of liquidity below your near close proximity minor sell side liquidity, which is this low. And this is the minor buy side liquidity because it's close proximity to where we're at right now. There's no other high because we've already cleared this one and we already cleared this individual candlestick there. So that means this is a minor buy side liquidity pool. Now here is the primary buy side. You think it's going to go just to fill in this. I'm going to submit to you that if it's going to go up here, it's going to run right on through to clear this. Why? Because somebody's up here short and they think that they're safe because this is retail resistance. So that is the primary buy side liquidity. Okay. So now the next question is this. From a narrative stance, and I am generally wrong when it comes to non-farm payroll. So I want to remind you of this, okay? We have an obvious drop that was precipitous here, going down into a weekly target we are looking for inside that buy side and balance sell side efficiency, that blue rectangle. Go watch the first 18 minutes of Monday's live stream. If you do that, you'll see where that blue box came from, why it was important, why I believed it was going to go down there as a weekly target. As it hit it, we haven't done much at all, have we? That's pretty interesting, isn't it? What could happen today is we could see it do some wild run up here, knock these individuals out, and then into next week go lower and not even take out these lows. That's something that could happen. Or it could go down because this is closer to get to this sell side, trip people short, and then rake it all the way across the coals and then pump it all day long up to get to here, and then go into the weekend where everybody thinks it's bullish, and then we start going lower next week. Or it could just do a little fizzing, moving around in here and leave both pools of liquidity, and I'm wrong and you're wrong and everybody else is wrong, and these get beat up. But these levels are here, and we're going to watch it on a 5-minute chart. And here we go. Already moved 100 handles. So the minor buy side's been tagged. It'd be real easy for it to drop down to get the minor sell side still too. It's a little lackluster here. I was expecting a little bit more punch having non-farm payroll before the election this year. Okay, since it's slow, we will go down to a 1-minute chart. So on this first candle at 8:30, the low came in at 20,064 and the high came in at 20,162. Okay, so 98 handles in 1 minute. Okay, so the first pool of liquidity they've taken is the minor buy side. So we're going to see, do we have any interest to go below and get that minor sell side? It's not important to look at the individual candlesticks. You're looking for the liquidity. For the first 15 minutes, you want to see what stops they run for above and below the marketplace. So this is accomplishing the method. You have your own chart you can look at. I just want you to submit to the idea of watching where it wants to reach for stops. What I'm looking at is this. I'm viewing it from this perspective. the buy side minor has been hit first. There's minor sell side down here. Because it's a non-farm payroll event, you may look at these lows here and think, well, that's where my eyes would go, not mine, because this low is already lower than that one, and this low is lower than that one. So I'm using this low and that low. That's what makes my liquidity pool, the first minor sell side. But I see this as the minor buy stops have been acquired here. And if this is the first side they go to at 8:30, someone could be interested in accumulating positions in here. And if they're running for buy stops with the idea that at a later time today that it could be potentially lower, where would they want to offload those? Below this low here. Or we're going up here, we're consolidating, accumulating to run to take the primary buy stops. I have nothing to frame that run on. I wouldn't want to take that trade, even though it looks wonderful in terms of the payout if you were to hold on to it. I would not do that. And it's still 8:35, so we have 9 minutes still. Now looking at it normally, this is what the chart would look like when you're watching it with me. A fair value gap, trades down until 1 minute before. We rally to take the minor buy side. Okay. Watch the wick. If it clears this high, it would need to run aggressively and not spend any more time coming back inside this shaded area. If it's underlyingly bullish and it wants to run. Otherwise, if it goes up and fails and goes back down and trades below this, this becomes rather a potential inversion fair value gap. Because normally where it's at now, because it's a buy side balance, sell side efficiency, and the market price is here, that means it would be normally expected to see it come down as a discount. And if it's bullish, this should offer a reason for the algo to offer that price and then reprice higher. But if it goes down through that and comes back up, that would be inversion, and we can use that to do a case study for the sell side down here. All right, so where we're at right now, it needs to continue. It should not ever come back down in here. The fair value gap in here, that's one that you want to have on your chart. Note that one. But this one here, right on the jump of non-farm payroll, because it was the candle that starts this big carnival ride. If it comes back below this, this is the one I'd like to see definitely as a inversion fair value gap to run down to here. And we have 1 more minute and 15 seconds, and then we can start looking for what's available for price. All right, now it's been 15 minutes after the non-farm payroll release. So you want to go through your charts and see what is left. Going back through price here on a 1 minute chart. Okay, nothing really to speak of there. You'll have to go to a 5 minute chart. I mentioned this down here, so I will already have this on the chart in the event that it does trade here. My interest in that is not to see it come down for a buy. I'm not looking at it like that. If it goes down there, I want to see it trade down through it, come back up, treat it as an inversion fair value gap to ride to minor sell side. That's where my interest lays right now. I'm not arguing and I'm not fighting what it's doing here. I'm just not interested because right now it's in an area where it's no trade for me. It's straight from 8:30 right on up. So what is this to me? In my mind, it's a Judas swing. I'm looking at this as bait. From this candle at 8:30, that low to this high has been one straight direction. No stop run, no candlestick taking out any trailed sell stops for anyone that would be long, because no one could get long. So all of this is just building in a premium ahead of the 9:30 opening bell there. And what I'm anticipating is I want to see us inside that 30-minute interval of time. I want to see some reason why during this 30 minutes, but it could happen before, I want to see it trade down into this. But I see this as just basically pumping it up, providing a premium. Now, here's where I could be wrong, and I'm completely content with being wrong. They could just keep pushing this higher, 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 higher to run to this as the daily objective, and that's it. That's the objective. I will look at something inside of the 9:30 to 10 o'clock opening range and see. I trust that if it doesn't get there before then, and it is in fact trying to get up there between these two time points, I have confidence that I would see something in there that would afford me an entry idea that would deliver from there up to there. If this is in fact what's going to happen, where I have to let go of the marketplace and potentially miss a move is waiting for the opening bell, because it could just keep on going up there, and it's a move that I just simply missed, and it's okay. Remember I was saying to you, most of you that see this big sell side and bounce, buy side efficiency, some of you are thinking when we were here that it's going to go up just to go in there. And I said, if they're going to go there, they're not going to be content with just going there. They're going to go to where the positions are protected. What positions? Anyone that was fortunate enough but not smart enough to have already gotten out of their short, they're entering inside this area. Anywhere in here, somebody, we don't need to know their name, we don't need to know their social security number or where their geographic location is on the spinning globe. It's not a flat earth, by the way. The consolidation in here, we have to look at someone went short. So to be short and hold the position with a stop loss, it's going to be at least a very minimum above this high. And because this high is slightly lower than that one, this means this is what? High probability, relative equal, high. So it's a prime candidate for it to be what? Taken. So don't subscribe just merely because there's an inefficiency here and think that, well, this is it. You know, we don't have to worry about anything else except for it going up to here, because it's already done that. I subscribed to the idea at the beginning of the stream that if it's going to go here, why not just go up here where the actual orders are? Because this isn't going to have a lot of orders. Just trading back up to that candlestick's low, that's not a large pool of orders. The large pool of orders is resting at this high and this high in this general proximity right here. Watch. And in that band right there, that's where the actual buy stops are. They're not at the top of the sell side and balance buy side efficiency. The delivery to price is just being offered there for the purpose and mechanism of efficient delivery. It's not that there's a specific number of important buy stops there. The algorithm is just simply trading there. So the pools of liquidity are absolutely at the highs and the lows. Okay, I had someone send me a comment that said, are there larger pools of liquidity that are not above old highs or not below old lows? No, there are not. The largest pools of liquidity are always absolutely above old highs, and that's buy side or buy stops, or below old lows, and that's sell stops or sell side. Again, the market goes up just to reprice for the purpose of efficiently delivering what? The counter delivery to this down move. Efficient market delivery is that it needs to create a candlestick that does this. Down close candle, for me, that's a black candle. And a green candle is a bullish candle on my charts. So it would be like this. It would deliver in the future some kind of a delivery where price is being offered going back up. We've seen that here. But that's not the end of the story. You got to think, why would it want to even go up here in the first place? Because it had inefficiency. It was only offering sell side delivery. That means movement lower. So if it's going to go lower, and the algorithm does two things. It reprices to engage liquidity. It doesn't know how many stops are above an old high. It does not know how many stops are below an old low. But where there are inefficiencies, where it's just one single candlestick that makes a range in and of itself, like an island, this one single candle before it, this candle, where that line is attached to it, this candlestick's low and this candlestick's high. This single candle has an inefficiency. It was sell side delivery, but it's inefficient in buy side. It means it hasn't offered price inside the time. Listen, folks, the time between this candle's high, that candle's low. The interval of time needs to be rebalanced with price. So price will go higher on the buy side delivery. It means overlapping the same price range between this candle's low, this candle's high. You are expecting in the future a pass right back up over top of the single candle. And once it does that and it touches this candle's low, this has been efficiently delivered. That is not a balanced price range. It just means it's been efficiently delivered. So back to the discussion about why that's simply not enough. The market going into this area and offering efficient price and not taking a ride into these stops, to me, would be a rather interesting observation today, because this is where the actual orders are. There are no orders, essentially, that are outnumbering, let's say it that way, the actual liquidity that rests in these highs. The market driven down into that target we had in the blue shaded area, that's the weekly buy side balance, sell side efficiency. It delivered that, and it delivered it quickly. And then we did not make anything lower. So the individuals that were sitting with the largest form of profit that's still open, if they're holding the shorts, their stop loss orders are here. Not all of them. Most of them already been stopped out with this return back to that high, this spike taking out that high, and then obviously the non-farm payroll today took out that high. But we're above this inefficiency now right here. So it goes without saying that non-farm payroll is used to disrupt what's already in play. What's in play? The shorts from here. Now, it could have very easily, from here, dropped down, disrupted these, and then made this the daily run. I would have rather seen that, to be honest with you. But as it is, we just started right at 8:30 and just started running right for this inefficiency. It's no longer inefficient now. It's been efficiently delivered. It is not a balanced price range yet. So we still have to submit to the idea that they're maybe going to take us up into here. So it can keep us real close to where the inefficiency high of the SIBI, and the SIBI is this. Let me draw it out in case there are new people here. This is the inefficiency. And you can see how we already painted right over top of this individual candlestick, that one right here. And then we have all of this delivery right back over top of it. You see that? This is usually seen with one single candle, but in here it took two. It's fine. Whatever it took time-wise to make this SIBI, you're always anticipating price to do the same thing time-wise. So between the interval of this candlestick's high, low to this candlestick's high, that same one single candle, you're always anticipating the delivery to be the same type of delivery on the other side. So that tells you a whole lot. It teaches you what? Speed and magnitude. Whenever you see me talk about when I'm in a live stream, or if I'm in a live execution and I'm recording the trade and I'm annotating by typing out what I think, and I'll say, okay, I expect to see speed in distance or speed and magnitude. I want to see speed. I want to see large candles now. It's underneath this idea where it's overlapping something that's inefficient. So if the inefficiency was manifested in the sense that it's been delivered to the sell side quickly and sudden, it goes without saying that you should see buy side driven quickly to reprice over top of this. Now that's not always the same, because sometimes you'll see that the market will go up a little bit and come back down, go up a little bit and come back down, go up a little bit and come back down, go up a little bit and come back down, and it just keeps grinding like that. That's high resistance inside an inefficiency. Those are the times where you're going to get smacked around, and it's just they're holding it back. Because in normal delivery, it should be single pass inefficient, single pass quickly and delivered. But if you ever see inside of an inefficiency like this, and it goes up in a little sputtering, little bit of move back and forth, that's a manual intervention as well. Why? Because we're inside of an inefficiency or a gap, and price is doing what? It's being held back, stagnant. Even though it's still pricing over and over and over and over higher highs, just realize that you're going to be in a trade that's going to have a whole lot more retracements. So if you're long, and say it's not non-farm payroll, you should not be trying to chase or trail your stop loss up. So we're not subscribing. I'm not trying to tell you to subscribe to the idea just because we go here, we're done. Because we've already done what? We went above it. So this is where the actual orders are. Right here. I'm saying, before we had the opening at 8:30 there, that this was minor and this is primary. And also stated that who's in profit right now at the time of 8:30? The shorts are. That's what the largest move lower. We haven't made new ground lower than that. We've consolidated. So don't just think that we're going up here to rebalance this. If we're going up here, I'm going to submit to the idea that they're going up there to cannibalize these position holders that are short, that have their stop losses here. And my eye is trying to look for evidence that it's going to continue to drive to here. And we're close to the opening bell. We're almost at 10 minutes after, so we got 20 minutes or so away. Being right here, they could use the opening range, the first 30 minutes, to drive up into this liquidity here, and then take into account what's going to be here when we look at regular trading hours. An enormous gap. Remember, we're sitting right here above this inefficiency. Price is sitting right there in electronic trading hours. And this is previous day's settlement price down here. So we have a very large gap. So if we're going to be in close proximity to those relative equal highs, which is the primary buy side, which you can't see it here. Notice that? But we're sitting right here based on actual electronic trading hours. Right now, the chart shows regular trading hours. So this is how we determine what our gap is, our opening range gap. Looking at electronic trading hours, we're sitting right here at the top of it. So is it unreasonable to anticipate them keeping price in this general area and then running it as a Judas swing on regular trading hours? So in other words, let me show it to you like this. Right now we see prices sitting essentially right here. It's the first time with crayons, folks. Sorry. The price right now in electronic trading hours is there. And this line, even though you don't see the relative equal highs because it's booked on electronic trading hours, this level, we could see it do this. Inside of regular trading hours like this, we could see it deliver a run up to here. Then let's assume, and I'm not saying this is the case, but let's assume that this is the gap. And we take the quadrants off, and we're just going to look at the trying to find the there it is. Got to pick some ugly color. That's the mid gap, that yellow line. So assuming that we opened here, and we're not opening there because we still have several minutes before it actually opens at 9:30. But just play devil's advocate. Say it opens at this price right here, and where we had the previous settlement price down here at 414 yesterday. This is mid gap, so it could open, trade up, bust out the relative equal highs in electronic trading hours. That's this. So open here, rally up, disrupt the stops, accumulate those stops, then drop down to mid gap right there. And then we'll see if it wants to go lower or not. Notice that it's also, when it goes to mid gap, it's basically coming to the high of all this consolidation. It's going to take a real move to get through all this. Not to say it can't, but that's what I see in price right now, and the potential scenario that may unfold based on what I see here. And look how close we are to them. And then you have the normal volatility in the first 30 minutes of trading at 9:30 to 10 o'clock. It's not unreasonable to anticipate him to pump it up another 100 handles to knock these individuals out. And then the real interesting study is, what do we do then? Because we have a huge gap. That 70% of the time number might not be the first 30 minutes if it goes down here at all today. It might take a little bit more time to get down here. And you can see we have an enormous gap in the making. So opening range, I'm anticipating maybe a little bit of a drop down, get people thinking, oh yeah, it's selling off because it filled in this gap. It's liquidity void, which it's not. There was trading in here, so that makes it's not a liquidity void, but the small little drop down and then run it right up into here. When we look at the daily ranges, okay, and I'm going to take our attention away from all the markups here. I'm going to delete them, and we'll come back to it in a second. We'll come back to it about 3 minutes before the opening bell. But we're going to remove the drawings and go to a daily chart. I want you to think about how when the market doesn't have an economic calendar event that's a medium or high impact news driver during the 8:30 to 10 o'clock. Crude oil inventories usually coming around 10:30. They're not really all that impactful to indices or equities. Like that's really that's not a factor. But usually you'll have a 10 o'clock news driver. There'll be a 9:45 news driver. There'll be a 9:30. There'll be a 8:30 or an 8:45 news driver. Maybe a 9:15 something will come out that somebody's speaking a speech or whatnot. Usually anywhere between 8:30 and 10 o'clock. That's like your time when some kind of an external stimulus will come into the marketplace and be used as a smokescreen to mask what the market makers are doing, whether algorithmically or manual intervene. Let's assume that there's nothing on the economic counter going into the next morning. Okay. And also let's assume that in the last hour of trading, the market trades down and cleans up a pool of liquidity below relative equal lows, or below a significant low that's been in the charts for several days. So during the last hour, they trade down, say when the market's bullish. It does this in the last hour. So it engages the sell side below an old low or relative equal lows that's been in the market for a few days. But they stop it right at the market close once that sell side's been taken. That is usually a wonderful time to anticipate at 6 p.m. when the market starts trading again, because at 5 p.m., assuming we're not on a Friday, at 6 p.m. they'll start the new electronic trading hours session. Wait until around 6:50 to 7:10, and you can start looking for reasons to be long then, and look for setups to trade into the 10 o'clock hour. Not that they all last that long, but that's the usual protocol I use when I'm trading Asia, with a high degree of probability that you're going to have a nice Asian range. That last hour of trading, it's got to upset some kind of liquidity and then stay there into the close. It cannot go down below a relative equal low or a singular low and then start rallying in the last hour. That doesn't give you the same high probability, because what is actually happening is in those instances, the last hour is being implemented for smart money to accumulate the sell stops, and they're just holding it there. And you'll see live streamers that are expecting a lot more protracted move lower, when then all they're doing is they're just keeping price there, and they're letting the last flow of orders coming in, which is a large influx, they're just scooping them all up, buying, accumulating. And then they know that in Asia, after the first 50 minutes of trading, the algorithm's macro will start spooling price, and then it'll tell them that they're on side or off side. And then the market, when it starts to rally, then they take every single discount array to accumulate more long positions going into the 10 o'clock hour. So if you look at some of the better days where Asia has had really nice price runs, study by contrast the last hour of trading in the index, and you'll see clues that you didn't see there before. That is the largest degree of probability for trading the Asian session, where you know it's going to be a good day to trade. It does not mean every single Asian session is a good trading opportunity. It's not. And I've said this ad nauseum. But the protocol I use is, it has to be a day where there isn't going to be any kind of high impact news drivers or medium impact news drivers, no speeches, no nothing in the economic calendar between 8:30 and 10 o'clock the next New York session. Because there's an absence of that, they're going to use many times the Asian session as the low of the day when you're bullish, or the high of the day when you're bearish. And if you look at the daily chart here, you can toggle back and forth, and you can see how the days close and open are real close to one another. Not all the time, depending upon if you're looking at how your chart's showing the settlement. But generally, you're seeing the bodies are very close to what the previous bodies closed or opened at previously. So that indicates there's something going on, but not always is it the low of the day. You see how close we are in proximity here between the previous close and where we opened? But we had all of this, and we had this in here. So you have to filter out all that. How do you do that? By focusing on the sessions. Asia, 7 o'clock to 9. That's your sweet spot. That's your little working area. Okay, and it can extend its price runs to 10 o'clock. But usually when we get into 10 o'clock, just square your positions. Or if you're trading with the pretense that it's going to be a continuation on the daily chart, and you want to capture a large range, and there's no economic news, medium impact or high impact, or speeches at 8:30 to 10 o'clock the next New York session, take some profit off at 10 o'clock, but leave a runner, some form of position still on it. And you'll see many times that Asia will start rallying up, and it'll have this uncharacteristic movement. It's like, where did this come from? Where did this come from? A couple weeks back, I bought right on market on close, and it was doing very similar things. I showed this with my private students. And in Asia, just kept on going higher, 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 higher. And it looked very similar to what we've seen so far on this. It was just doing something like this. And it's like, everybody was sending me comments in the videos. They were sending me emails. What's going on in Asia? What happened in Asia? And what I just explained to you is what happens. That's what happens. The smart money uses the market on close to enter, and then they wait for Asia to start, and then at 6:50 to 7:10, that first macro, it better start sending price in direction higher if they're long. And as it does that, every single time it comes back down to a short-term discount, they're accumulating it anymore. And what will happen is Asia will run all the way up into midnight. Midnight, you'll have small little retracement, but then London just keeps on powering up, or it'll consolidate all through a messy London. And Asia was the real run. London is a consolidation. And then in New York, you get another stage of what was happening in Asia. That's the first measured move. And then you'll see the same thing repeated during the New York session. And you'll be up 700, 500 handles on the day based on 6 p.m.'s previous electronic trading hours opening price to whatever the high of the day is that's formed in New York. So, as a reminder, that's not an everyday occurrence. That's not something that tells you that you have a good trading session in Asia like that all the time. But there are opportunities that you can trade Asia between 6:50 to 10 o'clock, because 6:50 is when the first macro starts to spool. And the 7:50 to 8:10, in my opinion, is better, because sometimes they can get a delayed start. So if there is no obvious run on price at the 6:50 to 7:10 macro in Asia, the odds of the 7:50 to 8:10 macro presenting something really nice for Asia, even if it is going to be a high impact or news impact session in the New York session later on, you'll still have a really nice opportunity to trade in Asia. It doesn't mean you're going to get 100 handles, but you can get anywhere between 25 and 40 handles in Asia when it's like that. When the 6:50 to 7:10 macro is silent, it's sitting still, the 7:50 to 8:10 macro in Asia is generally a nice 20 to 40 handle run. All right, so we are sitting with a very large opening range gap. There we are. And let's look at this on a 1 minute chart. These are the days where I'd like to see it not go to mid gap yet, but in fact, give this initial drop down here to get traders thinking it's going to go lower, and then rally it higher and go for the obvious buy side. Because if it comes all the way down to mid gap and decline from there all the way up here, then I'm convinced at that time that we won't just go here to go back down. It's going to go here and then consolidate, accumulate more, and go higher even still. If it goes down to the mid gap, then comes all the way back up here, that is not some kind of a run for turtle soup scenario to go lower. That would be indicative of this thing's going to go higher, a lot higher. That's what I want to see, that type of thing. Drop down and say, nope, let's rip it higher. So I want to see some kind of a fair value gap form as it runs back up into the high of that SIBI, which is this red shaded area. Remember, that's that inefficiency we were talking about all morning, how this is repricing back over top of it. We've already had multiple candles laid on top of it. This move here could be maybe an initial Judas swing. Short sellers are trying to trade the gap closure. Even my studies with the half gap, they might be trying to do that too. I don't want to see that right now. I want to see it rally and make an attempt to unseat these individuals, because that stays true to the form of what non-farm payroll really is. That's the nature of non-farm payroll. It's to disrupt those who are right now profitable. I'm watching this gap right here, by the way. All right, so far, opening range has been pretty much lackluster. This cutting through all this chaff here and focusing on this gap. I want to see if they use it, and then if it starts to spool lower, this gap down here, and then to 70% of the gap closure. I'm sorry, 50% of the gap closure, which is 70% likelihood of happening in the first 30 minutes, but I'm not holding it to today because it's non-farm payroll, and it's typical to break the rules, which is another reason why I don't like to trade it. Do you see any easy for you to say, ICT. Do you see any precision elements in price action so far today? Nope. So what did I teach you this week? When you see that lack of precision around my PD arrays, what's occurring? Who's in the marketplace pushing and maneuvering price? It's not the buyers and sellers. It's good old fill. Now, in an ideal world, if it's bearish, the upper half of this gap should not be closed in. Now think about what's below the marketplace right now. You have this discount wick, consequent encroachment. You have this fair value gap, and you have the 70% closure, 70%, 50% of the opening range gap that has a 70% likelihood of closing within the first 30 minutes of trading. So 10 o'clock is here. So you have a couple minutes. But I already subscribe to the idea that it doesn't have to do that today. What I was saying about this gap here, this gap there, I was telling you I was watching that. We came back up in. The body stopped at the upper quadrant of it. And then we broke lower, and we created this fair value gap. If this was going to be bearish after leaving this gap here, because it showed a signature at the upper quadrant, meaning this, look at the fib here, watch. This high up to the high of the volume imbalance, because you have to factor that in. And then the quadrant levels. I know I'm covering price, I'm sorry, I'm trying to be as quick as I can. The bodies are respecting the upper quadrant of that gap. So if the price leaves lower like this and creates another fair value gap, this is going to be a breakaway gap. So there's our delivery into our fair value gap here. And consequent encroachment of this wick would be next. And then half the gap. So breakaway gaps, I have a lot of people asking about, can I comment on that? What constitutes a breakaway gap? The consequent encroachment of the wick. Here comes the gap closure to 50%, boom. And it happened before 10 o'clock again. So there's your stats, still killing it ICT style. Mr. I don't think it happens 70% of the time. Here's the other gap I told you I'd like to see. So anyway, let me finish this thought here. Because we had this initial gap there, I wanted to see how price traded away from it. It did. And then I was watching when price was digging up into it. I was waiting to see how the candlesticks are dropped. Where are they burying the bodies? Okay. So if they're burying the bodies inside that gap and it's respecting the upper quadrant, that's the same thing. Even though it wicks outside of that gap, this is normal. We allow for that. What is that called? A mohawk. It's just coloring outside the lines. It doesn't mean something's inherently broken or wrong. It just means it just explored outside of that. But the bodies are telling you what? It's respecting the upper quadrant of that gap. And that means if we trade away from it, go lower, then it creates that gap with this candlestick's high. As I was telling you, this gap, I'm watching it, and if it trades up here, I want to see it leave the upper half of that gap open. Well, let's put the divider on it. And we'll put a red line in there. That way it stands out a little bit. Do you see the price stopping at halfway point and not going in the upper half of that? Pretty precise, isn't it? So because we left this gap in a manner of showing these signatures like this, and while I'm not willing to take the trade because it's non-farm payroll and I could be wrong today, what makes it a breakaway gap is that we've already have enough to set the stage, and this is the inception of the price run, this fair value gap. The signature was inside of that gap. Look real close, okay? As price was meandering around in here, remember I was telling you I want to get an x-ray view. I want to cut through all this chaff and get to the heart of what's really going on, this inefficiency. So the market drops down, comes right back up in. The body stops short of the upper quadrant. I'm seeing all this stuff with just rough eyeballing the high and the low of that white gap. In other words, I'm looking at this candlestick's high, this candlestick's open because that volume imbalance is there. This is not the proper fair value gap. That's not it. That's why you would get this type of distortion. You got to factor in that volume imbalance. If there's ever a volume imbalance inside of what would be viewed as a potential fair value gap, there is no separation between the bodies with the first candle and the second candle. There is a separation between the bodies on candle number 3 and candle number 2. Candle number 2's close is lower than the open of the next candle here. See that? That small little separation between these two price points here and there. So you have to draw your rectangle up there. So the benefit of having a real range like that defined and real inefficiency is that when you do quadrants inside of it, you're grading that price range. And if it's bearish, we want to see signatures that indicate that bearishness. The bodies are going to tell you the story. Watching price when it went up in here, look where the close is. It's below that upper quadrant. So is it laying the body down on top of the high of that shaded white area? No. This candlestick we open, we wick outside of it, and then what? Move away from it. So we opened below the upper quadrant. We allowed and afforded the market to do what? Create a little mohawk color outside the lines. But what does it do after it does that? Smashes down. Wonderful. When this candlestick closed, I said, okay, I'm watching this fair value gap here. Go back and listen to the stream. You'll hear me say, if it's bearish, you want to see it stay outside of the upper half. And then boom, it delivers right to the half of it. Not a tick more. Not one tick more. And then lower. And then aggressively moves down to mid gap, which is a strike rate of 70%, no matter what anybody else tells you, by 10 o'clock. And it hits it there. And it trades into the gap I was telling you about earlier, that this is my interest here. If it goes down, I'm going to see it go down here. If it goes below it and comes back up, treat it as an inversion fair value gap, then we look for minor sell side, and ultimately primary sell side over here. And when price is not illustrating that, when we were doing all this back and forth stuff, I mentioned, okay, are you seeing anything that showing elements of precision? Not yet, until we had that. What I've just described with the bodies, and then the displacement lower. Then that fair value gap present itself. Boom. Everything dialed in like an eagle's eye. I trained in on that. I put your attention right there, and the market delivered that. Now, the trolls won't see that as something useful. My question is, do you see that as useful? Do you see that as something that is a signature in price action that tends to repeat? You're seeing me actually identify it real time, and it frames the price run that you see many times after the fact, and you're like, what causes that? How is he able to do this? How does he keep getting away with this? It's because of the logic I'm teaching you. It's real. There is an algorithm, whether you like to believe it or not, and you can take advantage of these things. You can exploit them, just like smart money does. They're doing that every single day.